Today's top story is the Fed gets green light for interest rate cuts as unemployment rate jumps to four-year high. The latest U.S. jobs report just flipped the script.
All right, let's jump right into some absolutely massive news. This explainer is brought to you by Real Estate Rank IQ. And the headline says it all. The Fed just got the green light for interest rate cuts, all because the unemployment rate just jumped to a four-year high. Let's get to it. So, the latest U.S. jobs report just dropped, and wow, it has completely changed the game. It's one of those reports that resets everything, and in the next few seconds, you're gonna see exactly what I mean. First up, the big one, the unemployment rate. It just shot up to 4.3%, and to put that in perspective, that's the highest we've seen since 2021. A big jump. And then there's job creation, or should I say, the lack of it. The economy added just 22,000 jobs. I mean, that's practically a standstill. A huge miss from what everyone was expecting, and a crystal clear sign of a major slowdown. So you take that higher unemployment and the stalled job growth, and what do you get? Well, together, these two numbers have, you guessed it, just completely flipped the script on interest rates and the Fed's next move. Okay, so let's get into the nitty-gritty. Let's look at the numbers and really understand the data that caused this huge shift. And when you look at the whole dashboard here, it's pretty clear. It's not just one number, it's weakness across the board. You've got the 4.3% unemployment rate, the tiny 22,000 gain in payrolls, and look, even wage growth is slowing down to 3.7% year over year. Every single one of these key metrics is flashing the same signal. The red-hot labor market we've been talking about for so long, it's finally cooling down. And this chart just says it all, doesn't it? The contrast is just staggering. That huge bar on the left, that's what hiring looked like before. That was the trend. And then, look at August. It's this tiny little sliver. It's like the economy's hiring engine was roaring down the highway and then just slammed on the brakes. Hard. All right, so that brings us to the million-dollar question. How does all this bad news for the job market suddenly become a green light for the Fed to cut rates? Let's break down why this data unlocks that possibility. To really get what's happening, you need to understand this key term, policy space. And it's actually pretty simple. Think of it as the Fed's wiggle room. It's the freedom they have to cut rates and help the economy without worrying that they're going to pour gasoline on the inflation fire. And that jobs report we just looked at, it's exactly what creates that space for them. It's like a set of dominoes falling, one after the other. Step one, the labor market cools off. That leads to step two, the pressure comes off inflation. And that leads to step three, boom, the Fed suddenly has that critical policy space. And what does that lead to? Step four, a rate cut isn't just a maybe anymore, it becomes likely. And you know who isn't waiting around to see what happens? The financial markets. Traders are already putting their money where their mouth is. Just look at the odds for the next Fed meeting in September. That huge slice of the pie, that's the market betting on a 25 basis point cut. That's a 0.25% cut. The smart money has already spoken. Okay, let's talk about what this means for your wallet. For all you homeowners, investors, and real estate pros out there, this is where the rubber meets the road. Let's look at the immediate financial impact. The reaction in the bond market was instant. The 10-year Treasury yield, which is basically the benchmark that so many other rates are tied to, it dropped like a rock, down to around 4.05%. That's near its lowest point for the entire year. And because the 10-year Treasury fell, this number came right down with it. The average 30-year fixed mortgage rate dropped to about 6.29%. We haven't seen rates that low since last October. It's a direct cause and effect. And this really is the key takeaway. It's a fundamental rule of finance. When those long-term government bond yields fall, borrowing costs for just about everything else, mortgages, car loans, business loans, they almost always follow. And that direct link is exactly why this news is such a big deal for real estate. So, what should you actually do about all this? Let's get super practical here and talk about some actionable steps you can take right now, whether you're a homeowner or an investor. Okay, here's your strategy snapshot. If you're buying a home or refinancing, keep a very close eye on those daily rate sheets. And definitely ask your lender about a float-down option. That could let you snag a lower rate if they drop before you close. For anyone with variable rate debt, like a credit card, you can expect lower APRs. That's a great opportunity to attack the principal. Now for savers, yields are probably heading down, so now is the time to look at things like laddered CDs to lock in today's higher rates. And finally, for investors, it's a good time to double-check your bond exposure and be really selective about which stocks you own that are sensitive to interest rates. But hold on, it's not a 100% done deal just yet. There's always a catch, right? So we have to ask, what's the one thing that could completely derail this whole rate cut party? And it all comes down to one word: inflation. The single biggest risk here is a surprise spike in inflation. If that next consumer price index, the CPI report, comes in hotter than expected, it would throw a major wrench in the Fed's plans. And that's why, right now, the upcoming CPI report is the single most important number in all of finance. Everyone is watching it. So that's the bottom line. The Fed basically has a green light to cut interest rates, but inflation still has the final say. All eyes are now on that next CPI report. And hey, for more data-driven real estate insights to help you navigate all these moving pieces, make sure you visit realestaterankyou.com.